In this lecture, I want to talk about order types, and this is a very important lecture. First of all, there are many order types. We are going to cover the main order types. The easiest order is the market order, and that means your order will be filled immediately, but you may not get the best price. So if you recall, we have a bid and an ask. So you will be filled at the ask price because the ask price is generally going to be more than the bid price, but you'll get an immediate fill. So if you're in a hurry to get an order filled, if you want it filled immediately, then you would want to go for a market order. So when is a good time for a market order? Is when the bid ask spread is very less. So yesterday we saw on Apple, the bid ask spread was 1 cent. So in that case, if you want to get filled on an Apple order, you can send it as a market order because the slippage is only 1 cent. However, we also saw that on Priceline, the bid ask spread is over $1. And so then if you put in a market order, you're going to pay $1 and some change more than may be necessary. Now, granted, you can go to the mid price and try to get a mid price filled, but that would become a limit order. A limit order will be filled at the price that you specify. You may run the risk of the order not getting filled at all, because if the stock never comes to your price, then your limit order will not get filled at all. So that's the risk you run with the limit order. But in any case, in most cases, I would say a limit order is the right way to go. Then you have something called a stop order or a stop loss order, also called as a stop loss order. Basically what it does is it limits your losses. So let's say you bought Apple at $100 and you wanted to put a stop loss at 95. So which means if Apple falls to 95, you don't want to take any more losses. You want to close the position. And so this stop loss order will get kicked off and it'll become a market order. And so once again, if you put a stop loss order, you have to consider the bid ask spread and make sure that you're okay with the bid ask spread. It's not too wide because it does become a market order. And if you recall, the market order is an immediate fill and may not be the best price. To avoid that, there is something called a stop limit order, where it's the same as a stop order but with a limit price. So you can say my stop order gets triggered when Apple falls to 95, but I don't want to sell it for anything less than 94. So you can put that as a stop limit order. And then you have conditional orders where the order will only get filled when certain conditions are satisfied. So this is actually a pretty nice order. We'll show you some examples here. And I also want to put a cautionary word for stop losses and flash crashes, because a stop loss order becomes a market order. So under normal circumstances, when the market is moving orderly, this does not present a problem. However, there is something called a flash crash, and it happened in 2010. That was the biggest flash crash we have seen. A flash crash is when suddenly the market just starts dropping for no reason or for some reason and crashes very rapidly in a matter of minutes. And in that case, your stop loss order might get triggered, but the order then becomes a market order. But in a disorderly market, that market order may not find a price until it's much lower. So I'm going to show you an example of this flash crash and also an article that I did on my blog, because many investors lost their money on this particular day. So we'll go see that as well. Okay, so this is where we were yesterday. If you recall, we had put a Chipotle short and that is almost flat. And Priceline, we had a long, we had 5 shares. And you can see Priceline today is up about $17. And so our position, our 5 shares are going to be up about $99. So we'll keep these as is. Now, what I want to show you is the types of orders. So let's say we wanted to buy Apple. And let's say I wanted to buy 10 shares of Apple. And if I put this as a market order, it's going to execute at the highest price. If you look at it, it's 96.36 and 96.37. That's the bid ask spread. And now it's 96.38. So it's going to execute it immediately and you will probably not get the best price. So let's go confirm and send. And you'll see that it executed at 96.38, which was the higher price at that time. Now the market is moving, so now it's gone up to 96.39, but that's what a market order does. And similarly, if we wanted to sell Apple, create a closing order. So if you put a market order here, you're also going to get the lower price. It will sell it at 96.38. So basically, we would have taken a loss on this position. No, in fact, we did not take a loss because we had bought it at 96.38 and we sold it also at 96.38. However, the difference is that when you put a market order, you're not going to get the best price. You're going to get an immediate fill, but you will be buying at the ask price. And when you sell, you'll be selling it at the bid. Got to keep that in mind. Then the next type of order is a limit order. So now I can say I want to buy Apple, but I want to buy Apple. It's a limit order right here. So that by default, the platform puts it as a limit order. But you want to say that I want to buy Apple only if it is $96. I don't want to pay anything more than $96 for the Apple stock. So you can say 96 and you can confirm and send. Now, what's going to happen is it's going to remain in a working status, and unless Apple falls to this level, you won't get a fill. So if you recall the presentation on a limit order, it will be filled at your price only, but you run the risk of the order not getting filled at all. That's what a limit order is. Now I'm just going to cancel it. Let me show you some of the other orders. And of course, now we can put a stop loss order. So let's look at a stop loss. If I wanted to close this with stop, I would say that if it falls to, let's say, 1265, if it falls to 1265, that's my stop. So 1265 is my stop. So if price line falls to 1265, then this will become a market order. So it'll be executed at whatever ask price was at that time. So if I put a confirm and I send it, it's also going to remain in a working status because price line is not at 1265. And so this order will remain as working until price line falls to 1265, and that's when this trigger will get triggered and the platform will sell your stock at that time. The time in force, basically you can leave an order for the day or you can leave it until good till cancelled. So let's go take a look at that. So I'm just going to cancel this order and go back here and say price line. I want to create a closing order with stop. And I can put the stop as 1265. But I want this to be not just for today, but good till cancelled. So this order will remain overnight. It will remain open until I cancel the order or this condition gets satisfied and the order gets filled. So I can confirm and send that as well. And that should remain in working status until price line falls to 1265. However, this order is not going to get cancelled at the end of the day. This order is going to remain open for tomorrow, perhaps the day after, until this condition gets satisfied, or if we cancel the order ourselves. So I'm just going to go ahead and cancel it. And then there is also something called a conditional order, which will get executed when certain conditions are satisfied. And you specify what those conditions are. So let's go take a look at that. Let's say, okay, if we wanted to buy Apple, and to make it a conditional order, once you click on that gearbox, here you can set your conditions. So here you can say buy, I want to say 10, let's say 10 shares. It's a price rules is a limit order, and you can put your limit price if you want it, or you can make it a market order. Let's make it a market order to keep it simple. And time in force is also day. But here's where you specify your conditions. So if you wanted to say, I want to buy 10 shares of Apple when the SPX mark price, mark is the midpoint, is at or below. Right now, the SPX is at 1915.83. Let's say at or below 1910. Okay, so when the SPX falls to 1910, this order will get triggered and it will buy 10 shares of Apple at that time. So let's go ahead and save this. And once you do confirm and send, if you look at the order, it'll tell you that you're going to buy 10 shares of Apple at market price. The order conditions is that if the SPX mark is at or below 1910. So that's great. It tells you everything. And then when you click send, then that order remains in waiting condition. Now, in this case, we put it as a day order. You could also put it as a good till cancel order, and it'll remain open overnight, and it'll be open for tomorrow as well. So that's how you would put a conditional order. And here it says, you can see the status is it's waiting on a condition to get satisfied. So that's what a conditional order looks like. Now, the important thing is I wanted to talk about the stop loss order and a flash crash. So if you recall, the stop loss order limits your losses, but it becomes a market order. And so what I want to do is take you back to this particular day on the SPX. I want to go back. What is this? 20-year on a monthly basis, on a monthly thing. So let's go back. This was in 2010. So I'm going to have to go back to 10 years and day. But the day I'm looking for is May 10th of 2010. So let's see, here we are in 2011 and I'm looking for May 10th on 2011, 6/15. This particular, I'm sorry, I believe it was May 6th. So let's zoom into that particular day. We'll have a better idea. So this is the day I'm looking for. So if you look at this day, it's the S&P started out at 1164 and then around 2 p.m. the markets just started crashing, and from 1163 it fell to 1065. So that's 100 S&P points in a matter of minutes. And what happened was all these stop orders, the stop loss orders that were set at these levels, they got triggered. However, it triggers into a market order. And so a market order means whenever there is a buyer to buy this, the first buyer it sees, that's when it'll sell. But what happened when this flash crash was happening was there were no buyers. All the buyers had removed their buy orders. And so many people got executed somewhere at the very bottom. When some buyers started to come in, they got executed at the lowest level. And then, to make matters worse, the S&P bounced all the way back and came and closed the day at 1126. So investors really got a double whammy there. First of all, their stock was sold at the lowest possible point. And then, to make matters worse, they saw the entire market retrace almost all of the losses. No, it didn't recover everything, but it recovered about 65-70% of all the losses for that day. And so this became a big deal, and I actually have a flash crash and stop losses. I think my blog article should come up right here. Yeah, right there. I'm first on the Google search there. So this is my blog post on this particular event, and what ended up happening was this was the flash crash day, and the day was going like this. It was a negative day, but suddenly at 2 p.m. it just crashed all the way, and then it came back almost 60-70% back. And so what ended up happening is that most investors, including institutional investors who use stop losses, that day they saw their stocks really get sold at the very bottom. So you can read this article that I've written. It's a very interesting article. And in fact, there were so many lawsuits that started happening after that because, here you can see the stop loss orders and the flash crash, a false sense of security. Because once you put a stop loss order, you think you're secure. If the stock falls to that level, you'll be out of your position. But that's not the case in the case of a flash crash. And here you have an attorney who represented people who lost a lot of money on that day due to the flash crash. You can see here, stop loss order is a tool to protect investors by triggering a sale. Stop loss order is placed with your financial advisor to sell a stock. It's designed to limit an investor's loss on a stock. However, stop loss order is also known as a stop market order. It becomes executable once a set price has been reached and the order converts to a market order that is then filled at the current market price. Because a stop loss order is filled at the market price after the stop price has been hit, it's possible that you could get a sell order entered well below the set price in fast moving markets. And this is exactly what happened on May 6th, 2010. So just keep that in mind. If you have a stop loss and you think you're secure, it's not really secure. Now, granted, flash crashes don't happen all the time, but if they do and you have stop loss orders on all your stocks, you could be out of your positions at very big losses. So just a word of caution there. What you can do to avoid that is to put a stop limit. So, let's say Apple, fell to 95, and if you had a stop limit order to sell no less than 94, then you would be safe, because then it won't execute it at lower prices. Maximum you'll get executed is at 94. So that's how you would work around that. So that's just a little word of caution, because many investors got their investment accounts totally decimated on May 6, 2010, when the flash crash happened.